I'm Owen Bigland. This is the Inside Edge video blog. Okay, let's do a quick little blog here on just some investor characteristics, the rules that you kind of want to follow, whether you're buying real estate, you bought your principal residence, maybe you're buying an investment property, or saving for retirement, investing in equities, putting your money in ETFs, buying a Macdonald's or an Apple or a Meta or whatever else. So this is a guy I follow on Twitter. I follow, I think, about 120 guys on Twitter from all walks of life. I follow some trainers, some nutritionists. I probably follow a core group of about 40 investors. Some of these guys are private equity guys, hedge fund guys. Some are just individual investors. They're all investors, though. They're not speculators. These guys are like me. They research these companies. They index invest, but they buy individual stocks. When they pull the trigger on these companies, they are long-term holds. Unless something dramatically changes to the business, they're going to sit on these companies for 10, 20, 30 years or more. In some cases, collect the dividends, reinvest it. Just meat and potatoes investing that works. It's the only thing that is going to work for people. People seem to think they can trade their way in and out to a successful retirement. It's not going to work. Eventually, you might get lucky a few years, but overall, even the best of the best, only about 10 or 15% can beat the index every year. And they're working 10-hour days trying to outsmart the market. It's a fool's errand. But he came up here with this is a guy called Value Theory that I follow on Twitter. He came up with 8 key investor characteristics, and I've talked about many of these, but let me just roll through them here. Self-education, he recommends as number 1. So, hey, I've talked to you guys, the 150 hours you need to put in. You can't be spoon-fed this stuff. It's super easy these days to get that 150 hours. You can start with a video blog like mine, start with my book, read some of the books that I give you in the back of my book, go on to a site like Seeking Alpha or go on to a site like Canadian Couch Potato. Enjoy it. Enjoy the process of learning. But you can't be spoon-fed it. You have to learn this stuff. Even if you don't like it, just bite the bullet and get the 150 hours in, because then you will at least know enough of the basics to decide what you want to do with your money. Whether you're going to buy individual stocks with that, you're going to probably have to, do a lot more than 150 hours. How you want to index invest. Do you want to use an advisor or do it yourself? You'll know the difference between, what a dividend is, what the payout ratio is, the price to earnings ratio. Learn how to read a simple financial statement. Know how mortgage amortization works. All these things, interest rates, you've got to learn the basics. Detachment from stock prices. Yeah, super important. I pay very little attention to the day-to-day swings in the companies I hold. I don't need to, because I own the best of the best. I either own 50% of my portfolio is in indexes, the S&P 500, the Triple Q, the TSX. And then I own about 25 individual Canadian and US equities. The best of the best. They're run by incredibly smart people. They're not always going to have fantastic years. 2021 was incredible. 2022, I don't think is going to be nearly as good, but I entrust my money in these really smart CEOs. Every now and again, a company will run into trouble. I've had many over the years. They get into the doldrums. Even the best of the best. I've talked about Macdonald's. I've owned it for probably 18 years now. There's been some incredible years. There's been a few bad years where they've had a bad CEO. They always turn it around. All these good companies will. Monitor the companies you hold, but you don't need to pay a whole lot of attention to the day-to-day stock price. It has nothing to do with the underlying company you're holding. Remember that. Detachment from the headlines. Yeah, how many times have I told you guys, stop watching the news. It's a waste of time. I don't have cable. Don't miss cable. I'll get my news from other sources. I take in what I want to read. And you don't need to read a lot of the headlines, because most of it is fear-based. Most of it is trying to get you to do something, make a silly short-term decision. Best to just buy the best stuff, buy your real estate, and sit on your hands, enjoy life. Spend that time reading headlines and all the news on your family, on improving yourself, on getting enough sleep, eating right, exercising, and all that good stuff. Know what you know, and know what you don't know. I've talked about this many times before too. These guys that want to trade in and out of stocks, speculate, they think you're smarter than the best. And by the best, I mean these are, Wall Street veterans that went to Harvard and MIT and have got staffs that are doing research. even those guys are lucky to get about a 50, if they can, for every 10 stocks they buy, if 5.5 turn out to be winners, they're doing well. Only about 10 or 15% of these guys every year even beat the index, and they can't do it consistently. So don't play it. Know what you know. And what I know is that I don't know enough about these trading in and out of companies. I don't know enough about Bitcoin to invest in it. I'm not interested in it. I don't want to learn about it. But I'm in a different, demographic than most people are with Bitcoin. I'm already rich. I'm just trying to stay rich. And I'll invest in what I'm comfortable in and what I've educated myself on, which is real estate and S&P 500 equities. But don't try and trade, buy, hold, reinvest. That's what I know. I don't want to get into the speculation game because I don't know how to do it. Nobody does really effectively. Keep that, just remember that. Think in decades. Absolutely what I've told you guys. Think long term, whether you're buying your first home or you're buying your first ETF. This is going to be 10, 15, 20 year, 30 year, depending on your age, holding periods. Don't worry if you buy that S&P 500 index today and it goes down 2% next week or the week after that. It doesn't make any difference. Same thing if you buy your first condo, you have to get into a bidding war on it, probably pay $30,000 over asking. Listen, if you follow my golden rules, it's a long-term commitment for you. You'll look back on that $20,000 you had to pay over asking in 20 years from now. It'll be like buying yourself a cup of coffee. It's not going to make any difference. Certainly beats renting. You're right. You're in the market. You're creating equity two ways, as I've often pointed out here. Avoid greed, fear, and regret. There's lots of companies that, Tesla, for instance, I know I've got a lot of guys that in Tesla. I talk about Tesla in my book, as you guys know. At the time when I wrote that book 6 years ago, I said Tesla makes a fantastic car, but for me, it's not an investable company, and it still isn't. Although, mind you, I do own a fair bit of Tesla now, and I have for the last couple of years, because Tesla now is in the S&P 500. And it's also in the QQQ, the NASDAQ QQQ. So I do own indirectly Tesla, but I do not own it individually as an individual holding. Listen, that stock has done incredible. Would I wish I would have bought it 6 or 7 years ago? For sure, I'd be up over 1,000%. But you're not gonna win all of them. You're not gonna get every stock right. You're gonna miss out on some of these, and I'm totally comfortable with that. Instead, I've had Apple, which I'm up 14 or 15% on. I've got Google that I'm up probably at close to 1,000% on. Amazon that I'm up over 1,000% on. I've got lots of 10 baggers. You're not gonna get them all. And you have to remember that. Compounding is key. So yeah, just whether it's a house or a stock or an ETF, just let time do its thing. Let it run. Let the compounding continue. If you own an equity and it's paying you a dividend, just keep reinvesting that dividend either into that stock or that ETF, or buy something else that you think is more favorable at that time at a better price. Just let time do its thing. You've all seen those charts on compounding and what it'll do for you over 5, 10, 15 years. I mean, look at what compound, just simply, let's say, we're averaging on the S&P 500 now about a 16% return over the last 10 years. That's not normal. We've averaged, I think, over the last 80 years about a 12% return. Going forward, I don't know if we'll even achieve that. I'm pretty conservative on my returns. I'm happy if I were to get a 5% increase on my portfolio, capital gain on my portfolio every year. Plus I average about a 3% yield, let's say, on my portfolio. If I'd be more than happy with that, that would be 8%. If you compound 8%, your portfolio is going to double about every 7.5 years. So if you've got a $2 million portfolio, you're going to have $4 million in 7.5 years. In another 7 years, you're going to have $8 million. In another 7 years, you're going to have $16 million. That's compounding. But even a compounded annual return of 6-7% will do some incredible things over time. So stay with those basics. I know I've talked to you guys about these many times before. I like to just keep reaffirming this as positive affirmation for you guys. Investing, buying your home, saving for retirement, it's not that difficult. It's really a a pretty simple, keep it simple formula that will work. And that is always going to be in your favor. Don't try and go for the quick bucks here, with these meme stocks and trading stocks and buying futures contracts and options trading and using leverage and margin accounts. Keep it simple. Sleep at night. Let it compound. You'll do very well. I'm living proof of it. You don't see much in the first 10 years. After 15, you can kind of see where you're going. After 20 years, it's a gravy train. Trust me. I'm Owen Big. Thanks for watching. I'm Owen Bigland. I'll see you next week.